The impact of the COVID-19 pandemic on the economy and societies has been both deep and widespread in the globe. In Kenya, the initial shock hit many sectors of the economy as fear of contagion and severe restrictions on social proximity put economic activities on hold. According to the latest Economic Survey 2021, at least 740,000 Kenyans lost their jobs, with the informal sector being the hardest hit. On Moolah Insider this week, we take a look at new job market dynamics in Kenya after the onset of the COVID-19 pandemic and how the future looks like. My name is Margaret Wahito. Now we start our bulletin with the word of the week. Our word of the week is compound interest. Compound interest is the interest on a loan or deposit calculated based on both the initial principal and the accumulated interest. Now we start with our key highlights. The Nairobi County government plans to create additional income streams as it seeks to boost its own source of revenue. This is after the county government failed to meet its target once again. City Hall appointed the Kenya Revenue Authority as its principal revenue collection agent, and in the just ended financial year, it collected 9.7 billion shillings, an increase of only 1.2 billion shillings. This is a 6.6 billion shillings below target. In other highlights, new motor vehicle sales rose by 31.5% to 10,044 units in the 9 months ending September 2021. This is according to the latest data by Kenya Motor Industry Association. Commercial vehicle dealers benefited the most from the increased demand, including former dealers such as Isuzu East Africa, Toyota Kenya, and Simba Corporation. Isuzu posted the highest sales growth of 33.8% to 4,104 units from 3,067 units, followed by Toyota, whose sales rose by 32.8% to 2,386 from 1,796. Simba Corp units increased by 16.5% to 1,248 units. And now to our main story of the week. The COVID-19 pandemic has had not only far-reaching implications on the Kenya economy as a whole, but also varied short-term and long-term impacts on various sectors. According to fresh data from the Economic Survey 2021, an estimated 740,000 Kenyans lost jobs throughout 2020 following the effects of COVID-19 restrictions that affected various economic activities. Employment in 2020 declined by 4.1% to 17.4 million from a higher 18.1 million jobs at the end of 2019. This week on Moolah Insider, we spoke to Dennis Githenji, who is the head of telesales at Brighter Monday, and he takes us through the dynamics in the job market that has been brought about by the pandemic. Let's take a look.
Well, with the pandemic, what it did, it surprised a lot of us. And we did find that, for instance, a lot of jobs changed, not in nature of title or anything, but the way they operated. So we did see a great surge, especially in digital, and anything that supported that digital migration. So we found companies being forced from physical transactions to online transactions. And that meant there was a surge in anyone who did their infrastructure, that's ISPs. There was a surge in anything that supported them from the cloud side of business. That means network infrastructure. And there was also a surge in software development, as well as digital marketing. The jobs that are not doing so well include anything in education, though that is bouncing back. Anything having to do with hospitality, whether it's tourism or resorts or even restaurants, those are actually going down. And just looking more into the spaces, traditional role jobs, which were service delivery but in between roles, For instance, I'll give you an example. PAs are people like that who relied on physical contact. It's now going down because they're being replaced one by tools, which people are leveraging to be able to make their time more efficient, their time use, their time management, and those are actually going down. Office roles that support the office, that's for instance cleaners, receptionists. As more and more of us are working from home, you're finding that those roles are being reduced, especially roles that have to do with office space. App is artificial intelligence, data, software development, software engineering, digital marketing, digital setup of shopping carts, and freelance work, that's contracting, whether it's legal, financial, or even transcription or article writing. So those are on the up and up. Looking across the board, anything digital, everything technical has gone up. Of course, our health services, health hospitals have gone up, mainly because of the demand for healthcare. Overall, employees are quite happy to work from home. It gives them freedom. It also allows them to reduce the commutes. It allows them to interact with their families more, given that average commute in Kenya is around 1.5 to 2 hours. So it saves them a total of 4 hours, which they do use to interact with their family members. So that's a plus. And another thing is that more and more we are being judged on our performance and not other sort of like flower metrics. So before in the office, you'd see the guy who would put a biro in his mouth and fold his sleeves and look busy and walk up and down his files and get a promotion based on that. But at home, there's no one really to impress. It's only your work that's going to count. So more and more we're being judged on output. One downside of it is that now that we're working from home, companies tend to reach out to us at any time. So there's this invasion of time space, and you'll find that because you're at home and you're online, then that is taken to mean that you're available, which is not always the case. The country is going to bounce back in a big way because apart from the other things, the releasing of the lockdowns or the rules around vaccination and things like that, Kenyans tend to be very resilient and very creative. So you did find those an initial slump in retail, however they bounced back with delivery, and nowadays almost everyone is doing a delivery.
Jobs in the informal sector have taken the greatest hit at 544,000 compared to 194,000 jobs lost in the informal sector. However, the sector remains the greatest creator of jobs in the Kenyan economy, representing about 83.4% of total recorded employment by the government in 2020. Jobs in the informal sector now stand at 14.5 million, while those in the formal sector are at 2.9 million, which is the lowest since 2017. The number of wage employees in modern establishments stood at 2.7 million, while the number of self-employed and unpaid family workers stood at 156,000. You're watching Moolah Insider. For these and more stories, please remember to log on to www.moolah.co.ke or link with us on our social media pages. And now in pursuits, with the COVID-19 pandemic, many Kenyans have found themselves in tight financial situations. Many have lost jobs and businesses, sinking them into debt. In Pursuits this week, we look at what happens in case you lose your income and you can't continue paying your debts, especially loans from financial institutions. Let's take a look.
What banks will mostly look for is if you are listed negatively. And the negative listing is the one under a non-performing loan. The minute they see you're listed negatively, then your loan application stops. If the four of you came with the same exact salary, you may not all get the same amount of money. Why? Because of one, your spending habits. Also, what else do you have? What other obligations do you have outside? Once you get paid, some of us have other obligations. I'm already investing some money with Old Mutual, for instance, which then means I have a certain amount I must remit to Old Mutual every month, which then means that money is now not available towards a loan repayment. There's someone else who has a credit card already, which then means there is a certain amount of money they have to send to the credit card company, which also reduces their disposable income.
When we come to your profile, we should be able to see all the borrowings that you have undertaken in this market, and then see performance, which means that that performance then enables us to calculate your risk profile in terms of accessing credit.
Also, not having no credit is also not good for you. So someone straight from school or who is on their first job and they've never borrowed, they will not necessarily have a bad score, but they will not have the best score because we have no history on you. We don't know anything about you. You're clean slate. We are yet to figure you out.
Your credit report or your information on your credit bureau is very much like your CV. It's just that this CV is for you to be able to access credit.
Remember, the most important thing when you're giving a loan, you have to verify that this person has ability to pay this loan for the period you've given them for.
So banks will lend to you or give you a rate that reflects your risk profile. So somebody with a score of 600 will not get credit at the same rate with somebody with a score of 800.
Banks now are required to report both the good loans and the bad loans. In the report, there will be performing loans. Performing loans are all the loans you've taken and you have not missed a payment. Then there is loans now that were non-performing but have been closed. For instance, I took a loan, I paid nicely for 6 months, then I ran into trouble, I wasn't able to pay, so I was listed. Listing now is being reported as a defaulter. When do you, by the way, get reported to a credit reference bureau for not paying? Is if you've not paid your loan for 90 days.
In terms of what defined as a default in banking is 90 days. If you run through those missed payments for 90 days, if it's monthly, it means you have missed 3 installments, then now you go into default. You've gone into default. And that your record now changes from being in the performing list to the default list.
The regulations are very clear. So if there was any default, that default information is kept there for 5 years from the date you completed paying it, stating that at one point you had taken a facility and that facility went into default.
And after pursuits, we take a look at our leading indicators this week, starting with the stocks and the foreign exchange. Now, we also take a closer look at the Kenya shilling, which continues to be under pressure. Last week, the shilling depreciated by 0.2% against the US dollar to close the week at 110 shillings and 57 cents from 110 and 42 cents recorded previous week. This was mainly attributed to increased dollar demand from commodity and energy sectors importers, outweighing the supply of dollars from exporters. Money markets experts expect the shilling to remain under pressure for the remainder of 2021 as a result of rising uncertainties in the global market due to the COVID-19 pandemic, which has seen investors prefer to continue holding their investments in dollar and other hard currencies and commodities. There has also been increased demand from merchandise traders as they beef up their hard currency positions in anticipation of more trading partners reopening their economies globally. However, the shilling is expected to be supported by forex reserves, which are currently at 1.04 trillion, equivalent of 5.7 months of import cover. Next, we look at the prices of basic commodities this week. That's all we had for you this week on Moolah Insider. For these and more stories, please remember to log on to www.moolah.co.ke or link with us on our social media pages. My name is Margaret Wahito. See you next week.